Stock ticker JPM is a financial holding company that operates as one of the largest financial institutions in the United States with over $3.5 trillion in assets. They offer various financial products and services across traditional retail and commercial banking, asset management, and investment banking. Founded in 1799, the bank is now a $460 billion by market cap global financial juggernaut that employs almost 300,000 people. The company operates across four major business lines: consumer and community banking, 42% of fiscal year 2020 net revenue, corporate and investment bank, 40%, asset and wealth management, 12%, commercial banking, 8%. They also have a corporate business segment that results in insignificant negative revenue. JP Morgan Chase has a fabled corporate history, intertwining with moguls such as JP Morgan, John D. Rockefeller, Thomas Edison, and Andrew Carnegie. This is such a truly massive and important financial institution. The United States would have a difficult time coping if it were to suddenly disappear. From retail branches to credit cards to the financial markets, JP Morgan Chase touches just about every facet of U.S. finance. Simply put, it's a critical part of the American financial infrastructure. Here's how Morningstar describes the bank, and I quote, JP Morgan Chase is arguably the most dominant bank in the United States, with leading investment bank, commercial bank, credit card, retail bank, and asset and wealth management franchises. JP Morgan is truly a force to be reckoned with, unquote. If you think the economy of the United States will prosper over the long run, then you have to simultaneously believe that JP Morgan Chase will prosper over the long run. With a symbiotic relationship in place, it's nigh impossible to separate the two. I can think of no better country to bet on for the long run, which puts JP Morgan Chase in an excellent position to thrive for years to come. That should, in turn, translate to higher profits and dividends for shareholders. The bank has already increased its dividend for 10 consecutive years, and with the recent announcement that they plan on increasing the dividend by 11.1% with the next dividend declaration, that track record is about to get longer. Meantime, the 5-year dividend growth rate of 15.4% is stellar, and this double-digit dividend growth comes along with the stock's current yield of 2.7%, which is factoring in the upcoming dividend raise. This yield easily beats the market, and it's 30 basis points higher than the stock's own 5-year average yield. The low payout ratio of 31.7% easily protects the new $1 per quarter dividend. I like dividend growth stocks in what I refer to as the sweet spot. That's a yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate, and this stock is right in the sweet spot. Looking at business growth, JP Morgan Chase has grown its revenue from $97.234 billion in fiscal year 2011 to $119.543 billion in fiscal year 2020. That's a compound annual growth rate of 2.32%. Not bad top-line growth here, considering the size and maturity of the business. Earnings per share expanded from $4.48 to $8.88 over this period, which is a compound annual growth rate of 7.9%. A high single-digit earnings per share growth rate like that is rather solid, but this business is stronger than it looks, as fiscal year 2020 was undoubtedly a terrible year for bank earnings. Because they had to set aside a significant amount of loan loss reserves during 2020 due to pandemic-induced economic uncertainty, earnings per share for the year took a major hit. If we were to back things up a year or move things forward one year, their long-term earnings per share growth picture would look a lot brighter. For perspective on that, the 9-year compound annual growth rate for earnings per share between fiscal year 2011 to fiscal year 2019 is 11.52%. Furthermore, trailing 12 months earnings per share is over $12. Looking forward, CFRA forecasts that JP Morgan Chase will compound its earnings per share at an annual rate of 5% over the next 3 years. This is an extremely cautious take on the bank's near-term earnings per share growth potential, in my view. On one hand, CFRA has this to say, and I quote, "We see JPM as the best managed, large, diversified bank poised to benefit from high consumer and commercial loan activity," unquote. On the other hand, CFRA rightfully notes persistently low interest rates and reduced loan demand as major headwinds. I think it's wise to be prudent regarding a financial institution in this environment, especially since so much uncertainty remains. However, recent quarters have shown a serious rebound in JP Morgan Chase's numbers, with the release of loan loss reserves springing the bank's earnings per share back to life. With the economy normalizing, loan demand should follow suit. Plus, rates are set to rise within the next couple of years. Moreover, JP Morgan Chase isn't as heavily dependent on interest rates as some other competitors. They have substantial exposure to capital markets. In my view, JP Morgan Chase stands to do a lot better than CFRA is giving them credit for. But even if they were to put together a meager 5% earnings per share compound annual growth rate over the next few years, that'd still be enough to power high single-digit dividend growth. And with a near 3% starting yield, that's a pretty appealing combination of yield and growth. Moving over to the balance sheet, they have one of the largest and most complex financial makeups of all institutions. This can make it difficult to decipher exactly what's going on, but it gives them scale in an industry where scale matters, and scale proves its value in times of trouble, such as over the last year. The bank has $3.4 trillion in total assets against $3.1 trillion in total liabilities. JPMorgan Chase retains the following credit ratings for its senior unsecured debt: A2 Moody's, A- Standard & Poor's, AA- Fitch. These ratings are well into investment grade territory. Profitability is quite robust. Over the last 5 years, the firm has averaged annual net margin of 25.30% and annual return on equity of 11.73%. Net interest margin came in at 1.98% for the last fiscal year. There is a lot to like about this bank. It's an absolute powerhouse in every category it could possibly be a powerhouse in. And with enormous economies of scale, high switching costs, unique financial expertise, and built-up relationships, the company benefits from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. I see all three of these risks as elevated for JPMorgan Chase's particular business model. Banks are directly exposed to economic cycles. Any lingering scars on the economy from the pandemic-induced recession could harm JPMorgan Chase. While their sheer size is an advantage, it also limits their growth prospects by virtue of the law of large numbers. Low rates remain persistent and doggedly challenge the bank's profitability. Even with these risks, JPMorgan Chase strikes me as a compelling long-term investment idea for dividend growth investors, and that's particularly true with the valuation being attractive. The stock is trading hands for a price-to-earnings ratio of 10. That's obscenely low in this market, although some of what should have been last year's earnings are now showing up this year. Still, that's quite remarkable. The price-to-book ratio of 1.8 is admittedly on the high end of what a large U.S. bank can typically command, but I think this bank deserves a premium. And the yield, as shown earlier, is measurably higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This dividend growth rate is about as high as I'll go for a bank. Again though, if there's any bank that deserves a premium and the benefit of the doubt, it's this bank. If we look at what this company has done over the last decade in terms of profit growth and dividend growth, this is not a high bar for them to clear. Indeed, the upcoming dividend increase at over 11% is well over this level. And with the payout ratio being so low, they can easily afford to grow the dividend at a high single-digit rate for years to come. The dividend discount model analysis gives me a fair value of $172. The reason I use a dividend discount model analysis is because the business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates JPM as a 3-star stock with a fair value estimate of $143. CFRA rates JPM as a 4-star buy with a 12-month target price of $179. I came in very close to where CFRA landed. Averaging the three numbers out gives us a final valuation of $164.67, which would indicate the stock is possibly 10% undervalued. Here's the bottom line, guys. JPMorgan Chase & Co. is a very large and high-quality financial institution across the board. They performed admirably throughout the pandemic, and they're positioned to thrive for years to come. With a market-beating yield, double-digit dividend growth, a low payout ratio, and the potential that shares are 10% undervalued, this is a compelling idea in this market for dividend growth investors. And now for a special news announcement. Crown Castle International Corp, stock ticker CCI, just announced an incredible second quarter report that saw adjusted funds from operations grow 22% year over year. We highlighted CCI back in March as a great way to play the 5G revolution. The stock was $150 a share back then. It's now around $200 a share. But